All right, let's go ahead and get started. Welcome everyone to Abt Associates webinar series, Reimagining Private Capital for SDGs, and specifically to our inaugural webinar in this series, Bridging Private Capital Financing Gap in the Global South. Abt Associates is a global consulting and research firm established in 1965, and we work across global health, climate change, inclusive economic growth, technology, and governance. And in all of these sectors, Um, private capital plays a critical role in achieving our developmental objectives. And as such, this conversation is very dear and near to us. But quick WebEx housekeeping before we start. All participants will be muted for the duration of the webinar. You will have the option to ask us any questions, or if you have any technical difficulties, to reach out to us over the chat window on the bottom right-hand corner. The webinar is being recorded and we'll post this online very shortly as well. In terms of the agenda, we have about an hour today. We'll start with an overview on the webinar series itself and the inaugural webinar today to set the context. And we'll then have a round of introduction among our panelists and then dive right into the discussions. We have budgeted the last close to 10 minutes for Q&A. And thank you to all the participants who sent us your questions ahead of time during the registration. That's been really helpful. But if you have any additional questions during the course of the webinar, please feel free to send them across to us over the chat window. Great. With that, let's start with our webinar overview. The United Nations Sustainable Development Goals, or UN SDGs, as most of you are aware, are 17 strongly interconnected developmental goals formulated and adopted by the UN General Assembly in 2015. Most of these goals have targets that need to be achieved by 2030. Now, that's a really ambitious target. We are already in 2023, just short of 7 years from 2030, and significantly lagging behind most of these targets. While it was estimated back in 2015 when these goals were formulated that it would cost about $2.5 trillion annually to achieve these goals, post-pandemic, factoring in the pandemic recovery funding requirement and all the backlog of capital that wasn't raised over the last years, the current funding requirement for SDGs stand at a staggering $4 trillion annually. Of this, about $1.4 trillion is being funded through the public sector, which leaves about $2.6 trillion in funding required from the private sector. As such, it's quite well acknowledged across the development sector that private capital would play a pivotal role in accelerating the journey to achieving the SDGs. With that backdrop, it's quite encouraging to see that private capital for SDGs have indeed grown significantly over the last decade. Impact investing, which is an asset class that has investment objectives quite strongly aligned to SDGs, is an industry that's over $1 trillion in assets globally now. And a majority of these investors are targeting and achieving market rate returns, which is also testimonial to the fact that private capital for SDGs can be financially sustainable or return seeking. Now, all of these are great news. However, this growth in private capital has been highly skewed towards certain sectors and geographies. As you can see, over 90% of impact investing assets have been headquartered in the global north, which has an implication on the decision making and therefore the ability to diversify the geographies of investments in emerging markets. A majority of investments sectorally have also gone into certain specific sectors, such as financial services and clean energy. Therefore, to significantly scale up the mobilization of private capital for SDGs, it's imperative that we diversify the provision of private capital towards underinvested sectors and geographies. And this is very much in alignment with one of SDG's stated principles of leaving no one behind. In that context, we believe that the next phase of private capital for SDGs should focus on diversifying the private capital provision so that diversity across investment process, backing diverse entrepreneurs and diverse investment professionals, on sectoral diversification, focusing on underinvested sectors such as WASH, healthcare, education, affordable housing, and climate adaptation and resilience. And finally, making these investments happen through the use of innovative financing tools which can de-risk the private capital being mobilized. Abt Associates webinar series, Reimagining Private Capital for SDGs, will be a set of 6 to 7 webinars over the next 12 to 15 months, where we'll expand on these themes. And today we have our inaugural webinar, Bridging the Private Capital Financing Gap in the Global South, where we'll discuss the various opportunities and trends in investing in these underinvested sectors and geographies. I'm Arun Asok. I'm the strategic lead for private capital and impact investing at Abt Associates, and I've been an impact investor myself over the last close to 15 years. I'll be the moderator for your discussion today. And we are joined by a diverse set of panelists today, bringing insights from their extensive careers, both in the private and public development sector. I'll turn it over to them for a brief introduction about themselves and their organization's work in private capital. If we may go in alphabetical order as we see on the screen, Andreas, over to you.
Thank you, Arun, and it's a pleasure to be here, and thank you for including me in this event. My name is Andreas Eichin. I am the Senior Director of Structured Capital at Kiva Capital Management. I joined Kiva about 2.5 years ago when Kiva Capital was launched as an asset manager to run impact first, but also return-seeking funds. And I was hired to lead Kiva's expansion into this new asset class and new investment instruments across a number of funds. So I'm responsible for investment and underwriting development, pipeline development, portfolio construction. Prior to Kiva, I was also in the impact investing industry, working for about 10 years at Microvest, an impact asset in Bethesda. And before that, I was also, and I'm dating myself here, working in the financial inclusion and financial sector development space, but on the operational side, implementing microfinance departments in a number of commercial banks in Latin America.
Thank you, Andreas. Before we move to Deepa, and just maybe a very quick overview on sort of Kiva's work and Kiva Capital's work, maybe that'll be helpful as well before we move to Deepa for her introduction.
Yes, sure. So currently, we are managing 3 funds. One of them is domestic focused. It's called the California Rebuilding Fund. We're also managing a fund called the Small Business Resilience Fund. And, I will talk about that fund a little bit later, which was basically a fund that was coming out of the early days of the pandemic to provide pandemic relief. And then we're managing a fund that's called KRIF, the Kiva Refugee Investment Fund, that's targeting direct loans to refugees or internally displaced person or forced migration prevention products.
Thank you, Andres. A pleasure to have you on the panel. Deepa, over to you.
Hi, thank you, Arun. Good morning, everyone. Dipa Sharif, Senior Innovative Finance Advisor at the Center for Innovation Impact, or CII. We sit within USAID's Global Health Bureau and cut across different health sectors. So whether it's looking at maternal and child health, to AMR, to digital health, we work across these sectors and obviously work in low to middle income countries and underserved markets. My background has mostly been in finance, covering kind of different sectors from traditional mortgage-backed securities to renewable energy, WASH, agriculture, and then of course currently the global health sector. The interesting observation is that the access to finance issues and challenges are similar across the underserved sectors. And CII, we're looking at this. We're taking strategic risks to incubate new ideas and approaches in the healthcare space. So for example, financing solutions and interventions that have worked in other sectors and kind of bringing it into the healthcare space. So a simple thing is a working capital fund that has been around for a while, but not necessarily used in certain regions of the world in healthcare. Applying that. We also worked on the first healthcare development impact bond in India. We also support the implementation of innovative solutions in healthcare, and I'll provide more examples of our innovative financing work a little later on. And last but not the least, we look to replicate and scale these innovative and market-based interventions by working with private sector partners, as well as governments and other stakeholders. So looking forward to our discussion today, and thank you again to Abt for having me here.
Thank you, Dipa, and look forward to hearing more about it through the session. Kusi, over to you.
Thanks, Arun, and hi, everyone. First of all, just also want to echo and say thanks for the invitation to be here with you all today. My name is Kusi Hornberger. I'm a partner at Dalberg Advisors based in the Washington, D.C. office, where I co-lead our finance and investment practice, and I'm also our internal knowledge management lead. In that role, or in both roles, I would say I have a wide, vast viewpoint of what's happening and what is working and not working in terms of capital mobilization, placement of capital towards the SDGs, and in particular in hard areas like health, WASH, and affordable housing. I've personally been involved in more than 200 projects with family offices, foundations, development finance institutions, donors, etc., all intending to do good with their money. The question is, how do we scale up and do more of what they're doing effectively? And so I'm happy to share some of my thoughts on learnings from my experience. Then I would be remiss not to mention I recently published a new book. It's called Scaling Impact, Finance and Investment for a Better World. I will put the link in the chat if you're interested in learning more about the book. And I'm excited to share more when we have a vibrant discussion in a bit. Over to you, Arun.
Thank you, Kusi. And I just received the copy of the book just a few days back. I must admit that I haven't had the chance to go through a lot of it, but it's quite insightful already, and look forward to hearing more about it during the session. Over to you, Pranay.
Thank you, Arun. Thank you, Abt, for hosting the event. I'm Pranay Samson. I've been working at the intersection of development and finance for the last 15 years, spanning primarily a focus in Asia, but now growing in a focus on Sub-Saharan Africa and Latin America. I lead Plan International Canada's work on innovative finance, and it's a new space for Plan International globally as a large international NGO that works in over 75 countries. Plan has historically looked at child rights and gender equality as its core focus areas in a lot of the sectors that the other panelists have talked about, whether it's healthcare and education, WASH, agriculture, and economic empowerment, but has recognized the need, Arun, as you framed rightly at the start of the event, of the changing nature of the requirements of finance as we move towards as we move towards the ambition of global equality. The need for a group like Plan International to approach it from new ways and with new partnerships. And in this vein, Plan International has recently set up a subsidiary called Plan Catalyst, which will be working very closely in this ecosystem going forward, and look forward to talking about the ambitions that Plan has in this space going forward. Thank you.
Thank you, Pranay, and look forward to hearing more about Plan's journey, with the subsidiary and everything. Great. With that, let's go straight into our discussions. Dipa, if I may start with you, and I'm closing the presentation here. One of the key reasons that fund managers in these underinvested sectors and geographies are shying away from these investments is that they face similar challenges as the companies themselves, a lack of access to capital to deploy. And with the onset of blended finance, we are seeing more public capital trying to catalyze this private capital. So just from your experience within USAID, working on such blended finance transactions, what are your perspectives on the opportunities out there and some of the challenges in raising this private capital?
Yeah, thank you, Arun, for that question. Yeah, so I mean, as we know, there have been significant strides in global health outcomes over the last 2 decades with funding from governments and donors, including USAID. But I know I'm preaching to the choir when we say there's a huge gap. I think there's an estimated $130 billion annual gaps remains within health. So we do believe at the USAID that blended finance approaches are the key to help closing this gap by bringing in private sector investors. So I'll highlight a recent transaction that we supported on that will highlight the ways we're working in blended finance and how we're trying to tackle the kind of some of the challenges. So this is the Transform Health Fund. We recently finalized a $1 million catalytic grant funding towards Transform Health Fund, which is a blended finance fund focused on locally led and innovative healthcare supply chain models, innovative delivery models, as well as digital solutions in Africa. With a first close of $50 million, it's already demonstrated, 51 leverage to our financing, our commitments, and the target fund size is $100 million. The fund manager is Afrikinvest, who has offices in different countries in Africa. So again, promoting kind of the local voices and managing. They've been around. They're an experienced PE firm with over 30 years of experience. However, they haven't done much in the healthcare space, and this is their first healthcare-focused fund. So we're very excited about that. They've been able to bring in a diverse set of investors, including Philips, Merck, the IFCs, DFCs. They fall more on the commercial side of the capital space with higher return expectations, while others are more concessional and more impact-driven, like FSD Africa or MCJ, Amelia Foundations, are in the list. Now, the fund not only focuses on healthcare, but it also has a gender component to it. So it is women-led, and it will also prioritize supporting women's health services and investing in women-owned and led businesses. And Afrikinvest is also a signatory of the 2X Challenge. So that's really great to see. With this USAID's catalytic funding, what we're attempting to solve for is the challenge on one side of the equation where commercial investors are reluctant to invest in healthcare, whether it's the lack of risk appetite or high risk perceptions. So that's one side of the challenge that generally leads to lack of affordable capital to small and medium enterprises. But there is another angle, right? I mean, the other challenge in the space is that there's a lack of investable deals. And having worked previously as a fund manager, I'm acutely aware of this problem of building a robust pipeline of high impact investable deals, right? I mean, there's usually this tension of kind of deploying capital to larger deal sizes, but not necessarily the higher impact. And then you have maybe the smaller deal sizes, which will have kind of more significant impact potentially. So that's kind of that tension that fund manager constantly facing. And so one way we're supporting on the kind of the investable deal side of things is that we're also planning to provide technical assistance to a few of the Transform Health Fund's pipeline and investee companies. And this is through our Project Last Mile initiative. This is a public-private partnership with Coca-Cola Foundation, the Bill and Melinda Gates Foundation, the Global Fund, and USAID. This approach comes from a quote that I love. The quote is, "If one can find a bottle of Coca-Cola anywhere in the world, why not life-saving medicines?" Right? I mean, that's the kind of the mindset. So the goal is to leverage the expertise and network of the Coca-Cola system, their supply chain and logistic management experience, and help improve the uptake of life-saving health services and to enable medicines to go to that last mile and ultimately benefit the local communities in Africa. So this is just one example. There are many more ways that USAID is working in this space. And I'm happy to chat more about that, but I'll pause here.
Thank you, Dipa, and probably we'll use that quote as a byline for our webinars. But and I have a few questions to you regarding the success of blended finance itself and raising that private capital, but we'll park that to later part of our discussions. But in terms of these interventions, are you seeing the Transform Health Fund is Africa focused, but are you seeing similar opportunities in other geographies or in other allied or adjacent sectors to use blended finance to mobilize more capital?
Yes, absolutely. I mean, and that's part of the goal, as I mentioned. I mean, kind of replicating and scaling is the ultimate goal, right? So it's working here why not do it in other parts of the world? So absolutely. And one of the ways we're exploring and, you know, kind of leveraging the private sector, but also promoting more localization and addressing pain points like the lack of access to investable deals, right? So we continue to kind of explore ways of that there are a lot of accelerators, incubators, and, you know, IRPs out there, but this pain point still continues to exist. So we're kind of exploring different investor readiness programs in an effort to see if we could potentially support on that front. But yes, there's definitely lots of potential, and it's just more of a matter of addressing those pain points.
Understood. Great. And Kusi, over to you now. You've been an impact investor yourself, now a consultant and an author. There aren't many authors in impact investing, so that's great that you took that plunge. From your experience across these different career phases, could you give us some insights into some of the key challenges in raising private capital at scale for solving these key developmental objectives that we have? And also, what would be some of those disruptive changes, or if I may borrow from your book, the paradigm shifts that needs to happen to raise private capital at scale?
Yeah, thanks, Arun. Great question. The big one, right? And such an important question. I have to start by summarizing what I think is the biggest paradigm shift that needs to happen. That's not a paradigm shift in my book, actually. It's really that investors writ large, whether you're at the top of the capital stack or further down the capital stack, need to start thinking more about impact as a priority. And what I mean by impact is actually considering the non-financial benefits of what the investments do. I also think we need to think about shifting power and who's making decisions from the top of the stack down to the bottom of the stack. And we need to think about taking risk and the role of capital and the way it plays in development finance, from being crowding in capital to creating markets. So there's a lot that needs to change in terms of mindset. And I'll just start there as the biggest paradigm shift that needs to happen overall. And then if I look across my experience, what I observe at different parts of the stack, and these go into the specific paradigm shifts, if I think really about, let's say, LPs, institutional money, pension funds, sovereign funds, endowments, mostly in the global north, but not exclusively. They've started to incorporate risk mitigation practices such as ESG that considers things like women, things about the workforce health, et cetera, but doesn't really take an impact first mindset or internalize externalities. And so I think those players, as my paradigm shift number 3 says, need to start thinking more of an impact first mindset of what the role of their capital is as it gets funneled through the stack, and pushing the GPs or institutions that they invest into to do a better job in how they're considering and stewarding their capital. Then if I go further down the stack, the next typical rung from the donor goes to the development finance institution, although often it goes to large intermediaries as well. But the development finance institutions, unfortunately, don't properly leverage grant capital. Too often, they settle for, as I already mentioned, crowding in private capital as the sufficient metric, and that's called financial additionality or financial leverage. And the use of blended finance should actually be about much more than that. To me, blended finance should be about catalyzing and creating markets, creating innovations, needed health services and products, access to affordable care, et cetera, that don't exist in markets of the world. And so that funding, unfortunately, that it's being stewarded by development finance institutions, it's more worried about maintaining their credit risk rating and their ability to raise outside funding rather than actually truly creating markets and truly expanding the frontiers of where capital can work for good. And so I would pinpoint in my paradigm shift number 4 is, being catalytic and not just blended in structures. And then I'll go further down the stack and I will aim at, us, the intermediaries. We're not doing enough either, whether we're placing capital or advising capital. Too often we're pressured by those who are providing us capital to fall in that classic 2 and 20 structure or other traditional financing models, which are very much about mitigating risk and doing the minimum and not about actually understanding the needs and of what the beneficiaries, first of all, but the borrowers of that capital if it's debt or the investees if it's equity. And so those those actors and intermediaries go paradigm shift 2, which is they need to provide a more patient capital rather than a venture mindset in terms of how they invest. And that's not just about patience as in like long duration. It's also segmenting and understanding business needs. It's also about tailoring financing to come up with customized solutions to address those needs. So all of those things need to happen. It's not about one happening. It needs to be a concert of paradigm shifts happening collectively to really create systems change, to really reprioritize the role of capital in society, to really rethink and reimagine capitalism writ large. And so if we don't do that, we're not going to achieve the SDGs in any stretch of the imagination. We're just going to perpetuate and have a similar conversation 5 years from now. Thanks for the opportunity.
Thank you, Kusi. Very well articulated, and I think your point on the lack of impact or lesser impact first sort of solutions and the shifting of the power dynamics. I mean, as we said, over 90% of impact assets are headquartered in the global north, and that's the kind of conversation we want to facilitate through this series, and hopefully we culminate to having more of an awareness in the industry around this. Maybe a quick follow-up there, Kusi, as to are there specific opportunities and trends that you see in these sectors, say healthcare, education, wash, etc., that can help accelerate these private investments?
Yeah, well, I am also an optimist, so I don't want to be just a doomsayer that, everything needs to be reformed and we have to do better, but which is true, but I also think that we can do better and we are doing better. I mean, I was just reading the news today about the malaria vaccine, which is so freaking cool. Right, to be produced and manufactured in Ghana, like is an example. It's just a micro example, but like sort of, progress happens. And so I do see some trends, right? I see trends right now, even though the GIN data suggests that most of the investment's going elsewhere, there is activity in health and education, WASH, and affordable housing. It's not nothing. In health, I have a unique vantage point as we steward a community called Investors for Health Community. It's about 26 leading investors in emerging markets, inclusive healthcare systems, and their capital has been increasing in emerging markets in the last 3 years significantly. I mean, part of that's driven by COVID, right? There has been a huge increase, but I do think that that's going to stick a little bit. Healthcare has become the new sort of number 2 or number 3 theme area. So I'm quite excited about healthcare as an investment opportunity area for private capital writ large. And that's pretty a broad and generic statement, but in terms of specific areas where I'm seeing opportunities from the survey we did with our members, the 2 that rose to the top are digital health. No big surprise, everything that's intersecting with digital X is, basically there's a lot of flurry of activity, a lot of startup activity, and therefore a lot of capital because the promise is spectacular. The ability to lower cost, to access new markets in a whole different way is really interesting, and therefore, no surprises. There's a lot of activity there. The other is specialty clinics, particularly in low and middle income countries where access to primary care, while limited, is still available. Access to specialty care is particularly acute, and therefore we are seeing the need for, and therefore the prevalence of, private models provide specialty care emerging, and therefore there is actually opportunity for investment in those models. And so I'm quite excited about those 2 in specific. I think you can go broader. There's a lot of activity happening in other areas too. I'll stop there. I can mention other trends, but I think I don't want to hog too much mic space. Back to you.
Thank you, Kusi, and I'm sure we'll come back to this during the course of the discussion. And thank you to the participants for all the live questions and to the panelists for responding to them on the chat window. Now, if you may move to Andreas, and I'm going to put you on a spotlight now, Andreas, because you're a great example in yourself professionally of diversifying private capital, having had an extensive career in financial services and now at Kiva Capital looking at other sectors and small businesses. So it'll be great to hear from your experience as to the whole pipeline building process, identifying opportunities. How has that been? What size stage sectors of investable opportunities do you find for the Small Business Resilient Fund or the Refugee Fund? So that whole experience will be really relevant for our audience.
Thank you, Arun. And before I dive into the Small Business Resilience Fund, I would be remiss if since we have Dipa from USAID on here, be remiss if I didn't give her a shout out or give USAID a shout out for supporting Kiva with the design funding for a third investment strategy for our gender lens equity fund. That fund hasn't launched yet. We're in the fundraising stage, but thanks to AID, we've been able to go on a global listening tour for a year and a half and talk to numerous stakeholders what they would really want to see in a gender-focused fund. So hopefully there's more to come there fairly soon. Regarding the Small Business Resilience Fund, it is sort of the product of a very innovative and unique partnership with Google's Treasury, which was built on an existing relationship that Kiva had with Google to provide pandemic relief. And it really came together at a critical moment when our interest in supporting micro and small businesses and Google's desire to do so aligned. And literally, the fund came together during the pandemic when our sector was facing quite an existential threat. Everybody, I think, on this panel is aware what was going on with initially a worsening liquidity crisis and critical capital drying up to a lot of micro and small businesses. And then once the new reality had set in, with par 30 that we were all used to being in the single digits going to 40, 50, 60%, with unknown consequences in terms of future write-offs, we all feared that there might be a capitalization crisis sort of on the tail end of the liquidity crisis. So when we started designing this fund in cooperation with Google, we were trying to take all these things into consideration. And I really think the Small Business Resilience Fund is a very unique entity that way because it has a number of very interesting features. One of them is, even though it is structured as a fund, it is technically a separately managed account because Google is the only investor in the fund. So we're having very close relationships, not only with Google headquarters and Treasury, but also with local Google staff in the target markets. And that brings me to the first feature. The markets we're invested in are closely related to where Google is having substantial operations themselves. And so we've focused on a number of markets in Sub-Saharan Africa, mainly Kenya, Nigeria, Ghana, and South Africa. And then we're also targeting Indonesia and the MENA region. And there we're basically in Palestine and soon probably Egypt. That's still TBD. But the theory of change that the fund really has involved really goes around four sort of broad themes that we're trying to analyze when we're thinking about the portfolio construction. One of them is, of course, there's got to be some policy in place for the prevention of over-indebtedness. The potential investees must have client-centric loan products and some sort of data-driven approach to social performance measurement. That could be from a third party like 60 decibels as well. And then, of course, client protection principles. And the other interesting aspect of the fund is that we have a technical assistance component that any potential portfolio company can access. And there we split it up into sort of a light touch technical assistance component about client protection and policy improvements, but also we have an ability for a much more in-depth technical assistance component where potential portfolio companies can basically apply within sort of a larger project they would like to embark on. The other interesting aspects for the fund is that we are technically able to absorb local currency risk if we're talking about a jurisdiction where hedging is increasingly impossible or has been impossible from the get-go. And that is the hedging part, the extreme currency volatility that we've seen in the last year and a half definitely made it very difficult for us to place some of the funding. as sort of hedging prices literally exploded as a result of that. So having that flexibility is definitely extremely helpful. And then finally, and that goes back to my initial comment about the capitalization aspect, the fund has the ability in select cases to do fully Basel III Tier 2 capital compliant subordinated loans. So about 30% of the fund at this point are subordinated loans that our portfolio companies can use as equity in their capitalization calculation. So that's basically sort of the array of unique features that the fund has. So how it came about is we basically found quite an alignment and motivation to support small businesses, but also we were having presence and capabilities to go to the very specific regions and jurisdictions that Google was envisioning. And so we basically were able to make the continued capital flow of critical working capital to MSMEs happen. So I definitely want to commend Google for setting sort of this example for other corporate peers of that are involved maybe in the impact investing space or are interested in going into the space on sort of how they could align investments with those corporate values.
Thank you, Andreas. And I think that conclusion is a good segue to my follow-up question for you, which is for a scale-up of investment strategies like the Small Business Resilience Fund. I mean, you had the support of Google Treasury, but as you go forward, do you see enough investor interest in these non-traditional sort of investment mandates?
So I completely agree with what Kusi said about how some of the investor paradigms have to shift, and it's definitely gotten increasingly harder in this rising interest rate environments, and particularly when then you say when you tell an investor the type of markets you're envisioning that you want to go to. So it's definitely not gotten easier. But I do see strong potential in the example that the Small Business Resilience Fund has set. And just to give an example on Kiva on the marketplace side, that is the crowdsourcing platform, we have a product called Managed Lending where we're working with other corporates that want to have some sort of a more philanthropic aspect to their employee engagement, and we're basically managing the portfolios for them. What's interesting about SBRF is the example it has set with the Treasury side that's interested in capital preservation and also a return, but has made it clear time and again that the impact is really what they're actually interested in. And so we see sort of a lot of possibilities there in the future, how we could combine these products and create synergies maybe for a foundation as well as the commercial part of corporations.
Great. Thank you, Andreas. And Pranay, coming to you now, I'm sorry it took a while to go around the table. Thank you for your patience there. You've had an extensive career supporting social enterprises in Asia during your time at IAX, and now interesting to hear the whole journey within Plan International. I think what would be very relevant for the audience is to understand sort of Plan's strategy in creating this new subsidiary to enter into the innovative finance sector, and how you sort of complement the existing stakeholders in the industry. That'll be really helpful.
Thanks, Arun. And I really want to sort of highlight what my other panelists have talked about today and sort of ground the discussion in that. If you think about Plan International and the other INGOs that are present in the sector, in a sense, we are already playing this financial intermediary role of raising large amounts of funding from institutional donors and partners. We are part of the group that supports the current allocation of the funding that you talked about, Arun, in the SDG funding. But also it's sort of rethinking what our role is. from an impact first perspective. Kusi, really to your point, if Plan and other INGOs want to get involved in this space, how do we look at it from an impact growth perspective and not necessarily from how we would traditionally think about it from a revenue growth perspective, really thinking about impact maximization and reframing the question of, are we thinking about the SDG financing gap the right way? Is it purely about moving money, or is it how we move money? And Deepa, this is to your point on localization. Plan and a number of our partners are signatories to trying to change how we work as global INGOs in this space, taking a more localized approach. So it's really reframing that question and making the impact more effective, more grounded in what we do well. And what we do well is looking at gender transformative norms shift and looking at what we know works really well from achieving development outcomes and linking that to lowering both risk and increasing potentially returns as well as we think about the financial sector. So applying what we know really well. So Plan has exceptionally strong data. It has presence in communities, long-term relationships at a community level with governments in over 75 countries. So it has a wealth of knowledge and experience that it brings to the table, and also data to support it. So one of the tools that Plan has is the Women's and Girls Empowerment Index, which actually measures the ability for us as an organization to shift norms on the ground and how that then results in improved both development outcomes as well as potentially financial outcomes as well. So as we sort of reframe this question, I think it unlocks a whole new way of looking at this space for groups and invites a whole new set of players into this space, but it is grounded, Kusi, very much to your point, in an impact first approach. So I think that's critical as we think about it. And what Plan does really well is apply that with a very strong gender lens and grounding it in gender impact.
Thank you, Pranay. And maybe a very specific question, given plans and Plan Catalyst sort of focus on climate adaptation and resilience, which, as we all know, is under 10% of overall climate finance investments. Most private capital in climate finance goes to mitigation, and most of it within that towards renewable energy. So I think it might be useful for the participants to get a sense of any specific case study that you might have to just demonstrate how private capital can support adaptation or resilience.
So speaking to Arun, I think the question that you've posed. So Plan is trying to take a more responsive approach to what each and every community needs, and in that context, really take a portfolio approach to sort of say what is most appropriate for the communities that we work in. And that's very true when we think about climate adaptation and resilience. What communities need, which is the groups that face the brunt of climate change, are the communities that we work in on a day-to-day basis, and that has a very strong gender lens as well. We know that women and girls face the brunt of the impact of climate change. So when we're thinking about this context, an example that we've been working on recently is a coastal resilience project, where we are working in coastal Kenya on a project which was initially a very small pilot and has gradually scaled now to be quite a significant project that covers about 1,600 kilometers in coastal Kenya on seaweed farming and mangrove restoration. And this is sort of very pertinent because this builds community resilience, but also increases economic empowerment. The seaweed farming is predominantly done by women in the communities, and it creates sort of nature-based solutions in a way that we are really excited about. And also we can leverage now in connections to what we are sort of shifting in what we value as a financial community. The voluntary carbon market is flawed, but still exists, but also thinking about stacking of carbon credits, including biodiversity credits, and what we can prove as sort of gender impact in these local communities, that is really exciting. So at the moment, we have a new project which is looking in this particular area in coastal Kenya and Kilifi and Kwale County at about 1,600 kilometers of coastline. But that's a very, very small area. We can scale up that project with additional private finance to an area of over 18,000 kilometers just in coastal Kenya, but potentially downwards to Tanzania and onwards to Mozambique. And with that similar knowledge, we have the ability to scale that into areas in Southeast Asia and the Pacific as well. So the potential for growing this type of model of win-win partnerships is really what we are truly excited about as we apply innovative finance.
Thank you, Pranay. And I'm sure there are multiple participants here and panelists who would love to continue that conversation with you going forward. I had a few different follow-up questions for all the panelists, but interestingly, a couple of them already got answered during our conversations. But maybe one key question that I want to start with is, and please, it's really open for any of the panelists to respond to, but specifically, I'll look towards Dipa and Pranay's sort of inputs here. Blended finance has been quite instrumental in its ability to bring public and private capital together. There are a lot of public organizations now committing towards providing first loss or catalytic capital to different investment vehicles. However, the private capital mobilization on top of that have kind of had mixed success. It really depends from sort of investment mandates and sort of geographic and sectoral risks associated as well. So it'll be great to hear from our panelists on sort of the early proof of success of blended finance to bring capital to these underinvested areas, and what more can we do beyond just the first loss provision of capital to mobilize additional private capital. Dipa, if I may, put the spotlight on you there.
Sure. Yeah, no, that's a great question. I mean, and with the Transform Health Fund example that I provided, it's still early days. Fundraisers can close and deploy the initial capital to the invested companies, but at least with the initial fundraise, it was encouraging to see the diverse set of investors that have committed capital and that have come into play. So that's very encouraging. But in terms of mobilizing more private sector capital, and I think everyone's kind of covered it here, but just to again highlight, I mean, I think there are two key areas. One is definitely kind of impact measurement, right? I mean, we're still very stuck on kind of outputs and focusing on outputs, and there's not the same language that everyone speaks. So until private sector investors are able to see kind of clearly their return on investment on the impact side of things, not just financial returns, but able to measure that kind of outcome for the dollar invested or impact for the dollar invested, it's very hard to kind of scale and promote that investment because there's so many benefits that we're not necessarily incorporating into the impact metrics that are currently factored in. And the other is, again, I was alluding to this, is actually making these high impact investments more replicable and scalable. At this point, I think it's still very much ad hoc, like very small scale. The higher impact you have, it's still kind of towards the kind of the smaller scale. And bringing in the traditional private sector capital, you have to achieve the scale and replicability. Otherwise, they're not going to be interested. I mean, it's the same due diligence for a $5 million worth of loan versus, a $20 million worth of loan and a 200K loan, right? So I think the more we can sort of figure out a way, and of course it's easier said than done, to package, those high impact investment deals where investors are able to look into that. One interesting example is some of you may have already heard there's the Impact Investor Exchange where they've created these orange bonds. So that's kind of an example, right? I mean, that could be replicated in the healthcare sector. That would be interesting to see, but creating these kind of pools of, underlying loans that kind of package up to kind of a higher or bigger pool where traditional investors can buy into it.
Dipa, you just invited me to speak since I previously worked with IIX. And so, this is a good segue. I mean, I think what IIX has done with the Orange Bond series is really amazing in terms of bringing in large amounts of capital, the transparency on outcomes, being a listed instrument, and sort of bringing in both first loss and and principal guarantees as a part of the overall structuring. It is really, I think that's an emerging opportunity, having more clarity on impact. And that's one of the reasons Plan Catalyst has been set up, is to take what Plan does really well in terms of measuring out impact with a very strong results chain and offer that more broadly as an offering to the market to strengthen that reporting. I'm also really, what's really interesting me at the moment is shifting norms at the investment level. I think we aren't going to get there only with the focus on outcomes and impact reporting. the weight of investors to say you have to prove that you are achieving this impact and outcomes isn't there in a number of other investments. And that's where we see the need to shift power and norms, as Kusi talked about. So when we think about how investors invest in groups like FTX without the level of due diligence and evidence that they need, when there is a high risk perception in investing in emerging markets, the challenge is really how do we reframe that, particularly as we know the data that we have on financial markets and sort of risk has to be reframed as we globally face the challenges that the climate crisis poses to us as an audience here. So I think if we are really looking for equitable growth, we have to reframe how we're thinking about it as investors, as much as we need transparency on outcomes.
Maybe chime in on this. Is that okay?
Yeah, absolutely.
I'll just build. So I've seen a ton of leverage ratios, and in fact, I was recently asked by a client in the foundation system who was thinking about blended finance and that were like new to it and asking me, what's the leverage ratio I want to share with my boss, and the reality is it's really hard to pinpoint a number, right? I've seen things as low as 79 cents on a dollar from my colleague Paul Callan, who wrote an article looking at 117 transactions, sort of questioning whether leverage was really happening and what, if that should be the focus. And then I've also seen as high as like $20 to a single investment. But I think it sort of misses the point. And I think donors tend to fetishize a little bit the leverage ratio, and I think that's counterproductive. In fact, I hate to say it, Dipa, but USAID has put out RFPs where like they require leverage ratios, right? 10 to 1, 15 to 1, whatever. I think that the real emphasis should be on what's appropriate and what's needed. There's no question that grant capital, if you design the right way with blended finance, can crowd in private investment, right? There's no question. The question is how much and who's the right type of capital to achieve the impact we're trying to achieve. And then in second, I would say we also need to revalue the other benefits, the other types of additionality that are created, right? What I call ecosystem additionality, or some people call non-financial additionality, right? It's sort of what's the demonstration effects, what happens in the broader ecosystem as a consequence of whether or not that investment took place, right? That's the real impact that we care about. I know it's hard to measure, and in terms of time, it takes longer to understand whether it takes place, but it's where we should be placing greater emphasis as we think about the use of blended finance moving forward.
Thank you, Kusi. And I think what you mentioned about the appropriateness of the leverage ratio, also the timeline, because it takes time for the private capital to scale up, and maybe the initial few years are mostly supported through donor capital. In the interest of time, I think we should jump into our Q&A session. And again, thank you to the panelists for responding to all the questions that were asked, most of the questions that were asked on the chat window. So maybe we could start with some of the questions that we received during the registration. One question which multiple participants asked in one form or the other is, how do you envision private capital working for fragile or conflict-affected states such as Ukraine in a post-war or a post-crisis reconstruction planning? And I think, Andreas, you might be very well placed to answer this, also given your expertise with the refugee fund. But yeah, we can all chime in, but it'll be great if you could start us upon that.
Sure, and the fact that Ukraine is coming up is, of course, no coincidence. And even internally, we have been mulling over the possibilities of where and how we would fit in terms of that particular conflict. But quickly stepping back, just generally to the Kiva Refugee Fund, because I think there was also a question in the chat, sort of about certain jurisdictions. Obviously, the fund is targeting three particular impact themes: either direct refugee lending, forced migration prevention, or serving internally displaced populations. And so the jurisdictions the fund is invested in is sort of a function of where those things are happening. And why, and that takes me back to Ukraine. We still work through field partners. So the fund obviously is not investing directly to refugees. So it's going to be extremely hard to invest in a country that's still in the middle of an active conflict. But what we are trying to investigate and analyze is where some of those refugees have gone to some of the neighboring countries and who we may potentially be partnering up with. So that's obviously that would be a high priority. Going actively into a conflict zone, I think we would unfortunately have to wait until that conflict has resolved itself.
Thank you, Andreas. And I think another question that we had, which is quite aligned, is that is it possible to raise private capital in geographies where there's limited ODA support or even FDI support coming in? Maybe I could take a quick stab at that. I think the traditional wisdom says that most emerging markets start with significant ODA support, foreign aid support, and foreign direct investments coming in before the private capital, especially domestic private capital, can pick up. However, a lot of research in the last few years have, especially since the 2008 crisis, has debunked that myth, because there is a stronger correlation of foreign investments to regulations than it has with domestic private capital. So there are possible cases. There are several low-income countries, LICs, where there's a higher domestic private capital with limited foreign direct capital coming in, be it through ODA or private sort of foreign investors. But that's a lot more to do with the protectionist nature of those geographies as opposed to specific economics that's out there. In the view of most developmental sector players, it may not be the most sustainable form of growth because you need to have more competition and have more private capital coming in. Another question, or a comment rather, from Mila that I saw in the chat was regarding primary care versus specialty care. And I think Mila fully agree. We do need a village to solve for these issues, and there are different sectors and all of them need support. But fully agree with your point that primary care at the end of the day is the primary gatekeeper in the healthcare system. And we need to strengthen that as much as in developed markets as in emerging markets to ensure better health outcomes. But that said, there is still a lot of opportunity from a developmental perspective to still invest into specialty care and even tertiary care for that matter, providing services at a lower cost, providing point of care testing and sort of remote diagnosis methodologies. I think that brings us to the top of the hour. I would like to thank all of you for joining the discussion, and thank you to the panelists for a very lively discussion and the great insights and all the reaffirming sort of conversations between all of you. That is really interesting to hear. And also to the participants for the great set of questions that you asked. As mentioned, this is our inaugural webinar in the series, Reimagining Private Capital for SDGs. I know it's a lot on the tongue. We'll soon have an abbreviation for the series. And we look forward to seeing you in our future sessions. Having discussed the opportunities and trends in these underinvested sectors and geographies, our next session will focus on the risks and challenges of investing in these markets. The session is tentatively scheduled for the end of June, beginning of July. Please stay tuned to our webpage on the webinar series and on our email outreach for further updates. Thank you very much and have a great rest of the day. Thank you, everyone. Take care.